Geopolitical tensions in the Middle East dominate the current news cycle, fueling a narrative of impending economic collapse. These events coincide with a rapid shift in the global energy landscape, moving the world away from traditional trade routes and toward a new distribution of power. This shift is driven by the global race for artificial intelligence. To secure a lead in AI, a nation must possess an immense, reliable supply of cheap energy to fuel massive data centers. The maritime disruptions currently making headlines facilitate a massive transfer of market share, placing the United States in a position of global energy dominance. In the Strait of Hormuz, shipping companies recently reported receiving unverified threats, allegedly from the Iranian Revolutionary Guard. These messages claimed the strait would be closed to all traffic, despite no official confirmation from Iran. The threat alone triggered an immediate financial blockade. Western maritime insurance companies responded by refusing to cover any liquefied natural gas carriers attempting to navigate the strait. This diagram shows the Strait of Hormuz, a critical choke point for global gas. Without insurance, carriers are grounded. This effectively blocks access to Qatari gas, neutralizing one of the world's largest energy exporters. Europe has already replaced its Russian gas imports with American supplies. With the Middle Eastern route now deemed uninsurable, European capital is flowing directly across the Atlantic to secure the only remaining viable alternative, U.S. exports. By leveraging these maritime risks, the United States has successfully locked Europe into a long-term dependency, where energy prices are set by American producers rather than global competition. Increased revenues from these exports are already being reinvested. American petroleum firms are now positioned to modernize Venezuela's massive oil infrastructure, further consolidating U.S. influence over global supply. This shift creates secondary beneficiaries. Shut out of the European market, Russia is successfully redirecting its Siberian gas exports to China, providing the capital necessary to sustain its own economy. While the U.S. and Russia secure their resource interests, Europe and Gulf states like Qatar face a steady loss of market share and increased costs. Financial media and rating agencies continue to warn of massive market sell-offs and impending recessions triggered by these regional conflicts. This chart tracks the S&P 500. Contrary to warnings, the market remains resilient, trading steadily at 6,800. The volatility index remains low. Bitcoin holds at $69,000, and U.S. GDP growth is tracking at a robust 2.7%. The economic data shows that the fear generated by the press is disconnected from the reality of market performance. Major oil price shocks can certainly contract an economy, but the current market is successfully absorbing the geopolitical pressure in the Middle East. Investors should focus on the U.S. 10-year Treasury yield instead. This chart shows the yield testing a critical resistance level at exactly 4.30%. A break above this threshold indicates a genuine resurgence of inflation. This is a far more accurate signal of economic danger. Experienced capital looks past the geopolitical noise. By monitoring the yield and acknowledging the expansion of the U.S. energy monopoly, investors can see the clear tailwinds driving the domestic market.